Cloud. All right, thank you all for joining us. We are going to get started. So this is a Financial Literacy 101, Understanding How Money Works. And our first thing that we want to get started with is, of course, going through the discussion outline. And that is first the icebreaker, then we'll do an introduction of my financial story, the importance of money, cash versus credit, and learning financial responsibility. All right, so the first question for everyone, if you guys want to show your faces and turn your cameras on, we'd really appreciate it. We're going to be asking you, what is a financial goal that you have for yourself this year?
So I can go ahead and go first since I'm so hello everyone, my name is Lupe. And my financial goal is something that I've actually been doing, but I want to continue doing. Is just every time I get a paycheck, allocating the money in different categories and maintaining to that kind of budget that I put to that certain category.
That's wonderful, Guadalupe. Thank you for sharing. Would someone else like to share?
Yes, I can go next. Hello, everyone. My name is Noe Fernandez, and my goal is definitely to save up most of my money. Every time I get a paycheck, I save most of it, maybe 80 to 85% of it, and the 15% I could spend on myself. But that money is going to be paying back the loans that I borrowed from school. So my goal is to pay back all of those loans when I graduate, to graduate debt free. But yeah.
Nice. Thank you for sharing. Anybody else like to go? Feel free to, I know it's something that's not so easy to think about sometimes, but it's definitely, I'm sure everybody here has financial goals. So if you'd like to share out, we'd really appreciate it. All right, so I guess that concludes the sharing out. Thank you to Guadalupe and Noe for sharing. We'll go ahead and move on. Go ahead and start it off, Guadalupe.
All right. So first and foremost, why is money important? And so for this, money is important because it allows the economy to flow, and then it will also be a resource for your future in case you want to buy a house, which I'm sure most of us do want to do. If you want to invest your money in starting a business or having a family, it's going to be something, it's more like a necessity, it's a resource also. But yeah, that's pretty much it.
And when talking about money, I think it's really important to also note that everybody has a financial story. My financial story began when I was in high school, like many of you, and you'll be starting your own journeys and stories. You have to first, decide what kind of bank do I want to bank at. Some will go the credit union route, others will go the financial institution routes, like the major banks such as Bank of America, Wells Fargo, Chase Bank. And I decided to go at Bank of America because I felt that Bank of America was accessible for me to go anywhere. And for the most part, wherever I would travel to, there would always be a Bank of America nearby. I started my account there when I was 18. And I'm sorry, actually, I started when I was 16 because I got my first job at Carl's Jr. And that's why there's the Carl's Jr. picture there. And I used a debit card when I was 16 because I was able to get one. Also had to have my parents sign me, like help me sign me up for the bank account, which meant they had to be there to help open the account. And then once I turned 18, I could take them off my account because your parents have access when you open an account at 16. So for those of you out there that want to open an account, and if you're not at least 18, you'll have to have your parents consent and be there with you to open the account, at least for Bank of America. I also worked at Bank of America, and so I was also able to learn a lot about other people's financial stories. But all I have to say is that I decided to opened up my account there. And then even since I was 17 or 16, I've still been banking with Bank of America. And yeah, it all started pretty much began with me having my first job.
So now we'll be talking about the difference between cash and credit. So to begin with, cash is tangible and immediate. There's also no fees when you pay for something, which is something that may happen if you pay with a card. And then there's also no overspending. For example, if you have $50 and you go out, you can only really spend those $50 because you won't have access to more cash or more money in another way. On the other hand, we have credit, which is like a credit card. There could be a delay, like a 3 delay. Then it's also good if you're responsible with it, if you set your own limits, if you don't go past the limit that the bank gives you. Another benefit is that you can buy things now and then pay later whenever your payment is due. And then you can purchase anything with a credit card.
So why is credit important? Credit is important because you needed to eventually in the future get a loan to buy a house or a car if that's what you're looking to do. It's also important to have a good credit score because whenever you have to get your own apartment or your own place, you're going to have a credit score or some type of credit built, and they will eventually gift you in a lower interest rate, right? And if you have a really bad, poor credit score and it's really low, you'll end up getting a higher interest rate. And for those of you that don't know what interest is the money that this is basically how the banks and the lenders make money is through interest rates. The interest rate is a percentage that they put on however much money you decide to borrow. So for example, if Miss Guadalupe here says, I'm going to go buy a $30,000 car, then the bank can say, okay, well, with that $30,000 car that you just bought, we're gonna, because, obviously, I don't know that many people. I mean, I have friends and stuff like that, but who have 30,000 in cash sitting in their account. So Miss Guadalupe would want to go take out a loan. And then the bank will say, okay, Miss Guadalupe, well, we're going to charge you an interest rate of 14%. And that's really high, especially for a car. One of the lowest interest rates you can get on a car would be like 3-4%. That'd be a good deal. And Miss Guadalupe would need to have a good credit score in order to get a lower interest rate, like 3 or 4%. And then they're going to charge that on to what you already owe. And that's how they make money. Once a year, you can get your free credit report. And a credit report is kind of like a report card. You get to see your activity throughout the year and how you've been paying your payments. Have you been paying payments on time if you have credit? And all these things accumulate throughout time. And this is what will tell you yes or no if you have a good credit score or not. And you're building credit at the end of the day. So credit is super important.
So these are the 5 main things that kind of contribute to your credit score. So 15% of it will be made up of numbers of credit increase. 10% will be the diversity of your credit. 10% will also be the age of your credit, and then 35% will be the payment history, and then lastly, the last 30% will be the level of credit utilization.
And credit score ranges, just to give you guys a picture of what the numbers look like. You are considered to have really bad credit if you have anything less than a 520. As you can see on the right side of it, it says facing extreme credit issues, right? So what does that mean, Miss Jackie? That means that maybe you guys didn't pay, or maybe you, the creditor, didn't pay your payments on time. Okay. And so that's how you would keep getting this, or maybe you just didn't pay any payments and you just never paid a payment. Okay. And that's really bad. And the 520 to 579 says has several credit issues, unlikely to qualify for any loan. The 580 to 619 usually has some credit issues, will probably not qualify for most loans. 620 to 679 may qualify for most loans at significantly higher interest rates. And again, this goes, so if Miss Guadalupe bought that $30,000 car And it says she may qualify for most loans, right? So like, let's say she just had really like, this was her right here. She fit in this category. She was considered below average. Then Miss Guadalupe is going to end up with that 14% because she has a bad credit score. So therefore she can't get the 3-4%. Again, 680 to 719 may qualify for most loans at higher interest rates. 720 to 739, now we're facing to where you might be able to have those slightly higher interest rates. 740 to 779 and 780 to 850. This is considered very good and excellent. And you would probably have a lower interest rate. All this to say, we show you guys this because the purpose is to educate you guys on when you turn 18 and you graduate from high school and your bank is offering you credit cards. You want to be very mindful of the way that you use these credit cards, because at the end of the day, we have to pay these credit cards back. And if we don't pay them back, remember this part down here where it says worst, that's going to be where you're going to be at. Nobody wants to be down there.
So how you can build credit, as mentioned before, don't miss your payments. Number 2, calculate your spending like monthly, just to have your limits, your budgets, something to keep in mind. Also be patient because this can take some time to build. And number 4 would be, don't just blow your money. So just don't go and like buy a lot of things because you have a high limit, if that makes sense. I don't know, Jackie, if you want to add anything.
Yeah, again, it's really easy to just blow money nowadays. There's so many options and so many things out there, like Amazon, right? When we go on Amazon, we see 10 different things that don't, it's a bunch of, it's an array of different things, from food to workout clothes to shoes to a phone case for my phone. And basically that's controlling impulse purchases is what we want to do. We don't want to be just buying shoes because, oh, I got paid and I got this extra money and I'm going to spend $150 on these shoes that I probably don't need, when I could be like, no way, and I can put it away and just keep saving it to do other things like pay down my debt. And that's really important.
So here are 3 monies of money smart people. Number 1, they plan and budget wisely. They save within their means, and then they always find additional income sources.
Okay, sorry, I was writing somebody. Opening a checking account, again, you want to choose a right bank, go in person. I always tell students to go in person because you get more of that in-person feeling and you get more information in person, if that makes sense. If you don't want to read stuff, because online, when you open an account online, it's very straightforward, but not straightforward, if that makes sense, because you have to read everything. And then there could be those gray areas that you might have not known about that you are signing for when you're opening the account online. So just go in person and get a checkbook if you can. Checkbooks still exist. I know that sounds kind of like, why would I get a checkbook? Everything is online now, but it's also important to get a checkbook just to have checks, just in case you need a check, you got a check. And then lastly, if you are a person that's always on your phone, which is most of us, get the mobile app. You can check your balance. You can make transfers. You can do a lot of stuff on the mobile app, and therefore get the mobile app. All right, so we got a little video for you guys about opening a bank account.
Hello, everyone. In Module 2 of Basic Banking, we are going to learn how to open a bank account. But before we start, let's look at some important words for this module. Debit. When you take money out of a bank account or money is owed. Credit. When you put money into a bank account or when you pay for goods or services later. Deposit. When you put money into your bank account. Transaction. When you exchange goods or money. Before you open an account, you need to choose which bank you are going to use. To help you make a decision, you should ask the following questions. Does the bank have a branch that is close to where you live or work? It is important to have a bank near you if you need to ask questions or do your banking. What are the monthly fees? Banks charge a monthly amount called fees for having an account. They also charge small amounts for each transaction you make. It's best to go to the information desk at the banks you like and ask them what their costs and interest rates are. Then choose a bank that gives you low costs and good interest on your savings. When the time comes to open an account, you will be asked to give the bank your personal details, like a copy of your ID, and show proof of your address. You will also be asked what kind of account you want. There are many different types of accounts, but let's look at the two main types: a transaction account and a savings account. A transaction account is for any kind of action that you carry out with money. It's very useful for day-to-day banking needs like depositing and withdrawing money, paying bills, and receiving your salary. But because you don't earn much interest in a transaction account, they are not the best account to use if you want to save money. For this, a savings account would be better. They pay higher interest than transaction accounts, so your money grows while it is there. Some savings accounts pay even more interest, but only on the condition that you tell them a month in advance if you want to take out your money. Once you've opened an account, the bank will give you a plastic card called a debit card. You will then have to choose a secret number called a PIN code, which you should not share with anyone. From now on, whenever you use the card, you will have to enter your PIN code. With your debit card, you can withdraw cash at an ATM. When you go to an ATM, the machine will ask you to enter your PIN and which account you want to draw money from. It will also ask how much money you want to draw. If you have money in that account, the machine will give you the money. At an ATM, you can also do other things like check your account balance. This shows you how much money you have in your account. Pay bills, send money to someone, deposit money, or buy airtime. You can also use your debit card to buy things at shops instead of paying cash. If Peter is shopping at a grocery store, he doesn't have to pay in cash. He can just give the teller his card. The teller swipes it through the machine and asks him to enter his PIN. The amount he owes will be taken from his account and be paid into the shop's account. It is cheaper doing it this way rather than withdrawing money from the ATM first and then paying with cash. This means you don't have to keep going to the ATM to draw money to buy things. But while debit cards are better than cash, you must always be careful when using your debit card. Don't let strangers try to help you when withdrawing money from an ATM, and don't share your PIN number with anyone. So now you know how easy it can be to buy what you need and manage your money if you have a bank account. That's it for today. We hope you found this training module helpful. Goodbye.
Okay, next is where your money should go monthly. Number one, you should be saving, if you can, a good 30% of what your income is what's recommended that you save. Number two, bills and utilities, as if be anything that you're responsible for paying. Number three, insurance and phone bill. Just kind of adding on to those bills that you have. And number four, an emergency fund, which I think we'll go more in depth to. So other tips is don't live off of your from paycheck to paycheck. You know, you want to save money just in case you actually something comes up, or you just never know. Save at least 3 months. Save at least 3 months pay. So this kind of goes back to the emergency fund. You want to have 3 months worth of you kind of like being able to pay for what you're responsible for paying, just in case if anything unexpected happens, for example, such as COVID. Some people didn't save money and they weren't able to pay for their rent or other things. And that's why it's smart kind of just to have that money just in case anything happens. Number 3, always save the maximum when you can. So instead of spending it on something that you may not need, you can save it. It's recommended that you save it. And then also do not spend all of your scholarship money or financial aid. This can be tempting because sometimes students do get a lot of money, but it's smart to save it or just ensure that you are spending it for what you actually need in college. And that is pretty much it for our presentations. Here is Jackie's email if you guys have any questions, and also follow us on Instagram. And then this website is something that we recommend y'all check out. Does anybody have any questions? Or Jackie, anything you'd like to add?
I think that's it. So we just want to thank you guys again today for being here. Please feel free to ask us any questions that you may have in the chat about financial aid, financial literacy, opening up a bank account, credit cards. You can also email me. And yeah. Okay, well then that concludes our meeting today. Thank you everyone for joining us, and please follow our Instagram page. It's AHHS_CalSoap. And then we also have our CalSoap page.